Hi, everyone. Today we are going to continue talking about credit. This is the third lesson in our credit series. Now, when we borrow money, credit, we have to pay fees. So we're going to talk today about what does credit really cost. In the past, purchases were made either by cash or bank checks. People would go into a store with a certain amount of cash. They would walk around the store, gather their purchases, and then pay for them at checkout. And they had to have enough money to cover all their purchases, or they would have to put something back. Similarly, with bank checks, although the people didn't have to show that they had the money in the account, they would need to know how much money they had in their bank account in order to be able to write a check for the amount of purchases. In both situations, you needed to know and have enough money either in cash or in your checking account to cover the entire amount of the purchase. Today, cash and bank checks are used less often. They've been replaced with things like debit cards, credit cards, and touchless payments. And in order to use these things, there are costs attached to it. Remember that when lenders lend money, they do it to make money. In advertisements, it sounds like they are doing you a favor, giving you money to use now instead of having to worry about saving it up for later. But all that cash you need now costs you a lot of money in the form of fees and interest. Last week, we played a game that the idea of the game was to introduce you to some terms that are important when you're talking about credit. It was a fun way to figure out what debt meant, payments, missed payment, interest rate, income, penalties, and how it affects the money and the cost of the money you use. Now, touchless methods of payment are very popular, especially today because we're in the middle of a pandemic and people are worried about spreading germs. So, this touchless method is very convenient. Let's look and see what this means.
I'm Yaneli Espinal with another FinCap Friday brought to you by NextGen Personal Finance. When you think of somebody paying for something in a store, you probably picture them handing cash to the teller and getting a receipt back. Or maybe you picture them using a credit or a debit card to swipe or insert their chip and then give their signature. In a lot of different countries like Sweden, Australia, and Canada, even here in the US, lots of adults don't do any of that stuff anymore. Instead, they use contactless payments or tap to pay. That means they use their smartphone, smartwatch, or their credit or debit card to tap at checkout, and then they're done. Tap to pay takes about 13 to 15 seconds to process, and that's twice the speed of a regular debit or credit card transaction. Visa actually just announced that they're going to be releasing all of their new Chase credit cards with contactless payments. Customers are going to be getting a new credit card in the mail, which has the little tap to pay symbol on it. If you're shopping around and you see that same symbol at the checkout station, that means you can simply tap your card and go. Visa says they're releasing these cards to make transactions faster and easier for their customers. But a lot of people might still be skeptical. So here's a couple things you need to know about tap to pay. It's really unlikely that you're going to pay for someone else's transaction by mistake. In order for your payment to go through, you need to be about 2 inches or closer. If you make a series of purchases using tap to pay, then you'll probably be asked to enter your PIN number. This is one of the ways that they're going to be enforcing fraud protection. Research shows that when people use credit cards, they usually spend more money than they would if they were using cash. So just be careful that tap to pay doesn't make you spend more money than usual this holiday season.
One of the important facts about using credit cards, whether it be tap to pay or any credit card, is the fact that people spend more money when they are using credit cards. It's easier because they don't have to worry about having enough cash with them right then. But again, this comes with a cost.
I'm
The next thing we're going to talk about is payday loan.
Meet Jennifer. She's having trouble paying her bills and making rent on time. So, like 12 million Americans a year, she takes out a cash advance on her paycheck and she makes it through another 2 weeks. Problem solved, right? Not necessarily. Payday loans are different from other kinds of loans because you don't get to pay them back over time. You have to pay them back all at once. You can get them in lots of places, in storefronts, online, even in a few banks. To qualify, Jennifer needs 2 things: income, easy, she's got a job, and a checking account. Jennifer is short $375 on her rent, which is also the average payday loan amount. To get the loan, she just has to agree to pay a one-time fee of $55. 2 weeks later, though, Jennifer's situation isn't any better, and she can't afford the $375 to pay back the loan. But she can afford another $55 to renew the loan. If Jennifer is a typical payday loan customer, she's going to do this again and again for 5 months of the year, paying $520 in fees, all for that original $375 loan to pay her rent. Jennifer's story is a common one. Payday loans are marketed as short-term solutions for emergency use, but the reality is quite different. To learn more about payday loans, who uses them, and why, check out pewtrust.org/small loans.
Now, that video showed how easily it is to get caught up in borrowing money to pay for things now and then not being able to pay the loans back. And all that happens is that the fees and the interest keep on growing and growing until you're totally out of control, just like in the game with the cats that you had to feed. Advertisers will get us caught up in this. This is a commercial that I am sure you've all seen before. Now, this is a little different because this commercial is telling people that they could borrow their own money from either insurance or annuities and things like that. However, the message is still the same. They're using gimmicks and the appeal of getting it now in order to lure you into paying more.
I have a structured settlement and I need cash now. Call J.G. Wentworth, 877 cash now.
I have an annuity, but I need cash now.
Call J.G. Wentworth, 877 cash now. 877 cash now. They have thousands, they'll help you too. One lump sum of cash they will pay to you. If you get long-term payments but you need cash now, call J.G. Wentworth, 877 cash now. 877 cash now.
877 cash now.
877 cash now.
It's your money. Use it when you need it.
Call J.G. Wentworth, 877 cash now.
Now, in this commercial, they're advertising get your annuity now. An annuity is a series of payments you get from money that is yours over a period of time. It's an agreement that was entered into when you put your money into the annuity. That money is yours, but you put it into that method of payment. What J.G. Wentworth and companies like them will do is take that. They will restructure the loan for you and give you a big cash amount right now instead of you having to wait for each of those payments each month or year or whatever the timeliness is of those payments. But they are going to take a big chunk of that money for themselves as well. They don't tell you that. They make it look like, well, it's your money, you can have it, but it's coming at a cost. Sorry.
I have a structured settlement and I need cash.
So we're going back to the debt and the words that we talked about. So debt is what you owe. In the game that we played last week, the cats are the debt. The more cats you have, the more money you have to put out in order to keep them fed. Debt is the same way. All of those fees keep multiplying. If you're not paying down both the amount that you borrowed and the fees, they're just going to keep on multiplying and it's going to get out of control. The scoops represented the payments that you have to make. You give a scoop to the cat and it's happy for now, but giving less will hurt worse later. Obviously, the dead cat is a missed payment. This will hurt your credit score for years. If you miss a payment, they might give you a grace period or maybe give you one missed payment grace period. But over time, those missed payments are going to go onto your credit report. When your credit report, we'll talk about that later, but on your credit ratings, the lower your rating is, the less you can get. That means even things like mortgages, buying a house, even jobs are connected now to your credit rating. So you don't want to have missed payments. The interest rate is the amount that they're charging you to borrow the money. There's different rates and it's compounded over time, so it keeps on increasing. It never stops. The bag of food is your income. You only get so much in a bag of food. Just like that, you only get so much money for working, whatever it is that you get. You can't spend more than that or you're going to end up owing people. And the kitty karma is the penalties. You miss a payment and you'll get hit with a fee. The idea of all of this is to make you understand that in order to have what you need financially, you need to make sure that your income is at least sufficient to cover your purchases and the things that you spend your money on. If you start spending more than you have coming in, you will get into trouble quickly. As always, I hope you have a great week, and if you have any questions, you know how to contact me. Talk to you next week.